Morning.
Sure.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, liberty and justice for all. Okay, the Mendocino County Board of Retirement meeting for September 18th, for December 11th, 2024 is called to order at 8:31. Yeah. Would a roll call, please?
Mr. Kelly, absent. Ms. Cavanis,
Here.
Mr. Cromer,
Here.
Mr. Shoemaker, absent. Ms. Harris, Mr. Swope, Ms. Pierce,
Here.
Mr. Land.
Here.
Thank you.
Okay, members of the public are welcome to address the board on subjects both on and off the agenda. Public comment on individual agenda items will be allowed at the time an agenda item discussed. Do we have any members of the public wishing to make public comment at this time regarding an item not on the agenda?
There is no public comment at this time.
Okay. Our first item on the agenda is election of the Board of Retirement Officers for 2024-2025 and appointments to the Audit Committee and Ad hoc Committees. So I would like to, we're going to do elections, so I would like to nominate Alex Land for a new board chair, and then we will, are you interested, Alex? Okay, so, and then we will vote on that. And we also need to nominate and elect a vice chair and a secretary. So are there any, is anyone interested in either of those positions?
Alice can attest that secretary is a pretty light job. There's not a lot of activity there.
Yeah, I think everyone forgot I actually was the secretary. I had to remind people on the very last meeting.
It was important.
Yes. So traditionally, I believe that if nobody volunteers, the people who are absent get assigned.
Good idea. Great. Secretary?
What are the duties of the secretary?
They're very light.
Your name is listed as secretary, and that's pretty much the only duty. You didn't do anything as secretary, did you? You're supposed to ensure that the minutes are done, but staff does that, and we've never not had minutes, so.
Yeah, so pretty much
I don't mind.
ceremonial title.
Okay. Okay,
Does that require a motion, Jeff?
Okay. Is there a motion for electing the new officers for chair, vice chair, and secretary? Is there a second?
I'll second.
Roll call?
Ms. Cavanis,
Yes?
Mr. Cromer,
Aye.
Ms. Harris, Mr. Swope, Ms. Pierce,
Aye.
and Mr. Land.
Aye.
Thank you.
Okay, congratulations to the new officers of the Retirement Board. And Alex Land, I will turn the chair position over to you.
All right.
And you can appoint whoever you would like for the Audit Committee and also for the Strategic Planning Committee.
Sure. I did talk to Sarah, and I believe she was interested in continuing her participation in the Audit Committee. Trustee Pierce?
Yes, that is correct. I'd Don't mind remaining on the audit committee.
Okay, and the audit committee also requires a chair, I believe. I'm not sure if that's something that automatically falls to me. I haven't seen the rules. I don't particularly want it.
Oh.
But I will take it if it's required and/or there's no other volunteers.
My understanding is it's not required for you to be the chair of both.
Okay,
So-
are you interested, Trustee Cavness, in
Sure.
continuing your, would you like to chair the audit committee?
Yes, unless someone else would like to do it.
Okay, do we need, we need 3 people for the audit committee? Okay. 4. Doesn't look like I have an easy way out. Unless Quincy does, which I'm betting he doesn't.
I have no desire, thank you.
Yeah. Based on his responsibilities in his day job, I understand that. Okay, then I will act as the 4th person,
Okay,
but I will not be chairing that. And I guess that leaves us, do we need to vote on that, or is it just,
appointment.
okay, straight appointments? So be it.
And then the strategic,
And what does that require?
That committee is an ad hoc that assists with any strategic plan projects that need some board input, like, I forget what they last met on, but it might have been the IT item or an item after that. But we could probably hold on that and come back to it if we actually are going to need the strategic planning ad hoc committee, and just have them appointed at that point in time.
Okay, I'm okay with that, of course. And that would leave us moving on. I guess we would need to ask for board member comment or discussion on any of the things we talked about on item 2. Seeing none, is there any public comment?
There is no public comment.
Okay, and do we need a motion at this point? No? Okay. And so then we will not need a roll call vote either, so we're done with item 2, and we can move on to item 3, the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Okay.
Trustee Land? The calendar is item 2.
Did I miss the calendar?
Yes.
Okay, let's,
Item 1.
I did, let's move on back to the calendar. I have it up here. Is there any board member discussion about the calendar?
I'd like to mention a couple of items regarding the proposed calendar for 2025. You will notice that the November meeting has been moved to the first week. This is to get our valuation report a little bit earlier and to assist the county with completion of their reporting. That goes back to our previous practice. We had only moved it back to the 3rd Wednesday like a year or so ago. Also, in December, we left the meeting on the 3rd Wednesday rather than move it up a week as was done this year. And we did include the July Audit Committee meeting on this calendar. It's on Wednesday the 9th, but that's just the committee, not a full board. If you have any questions or suggested changes for any of the dates of the meetings, you can let us know. We did feel that the December meeting was going to be far enough from Christmas that it wouldn't be a concern to have it on the 3rd Wednesday.
So are there any, do any board members have any discussion on this at this time? I would like to say that it is going to be a quick turnaround. Oh, wait a minute, never mind. We do have 3 weeks between the October and November meeting. So I have no discussion. Do we have a motion?
I'll
So
make a-
moved.
Second.
Roll call vote, please.
Ms. Cavness?
Yes,
Mr. Cromer?
Aye.
Ms. Harris? Mr. Swope? Ms. Pierce?
Aye.
Mr. Land?
Aye.
Approved.
And now we can move on to the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Do any trustees wish to pull an item from the consent for discussion? I see none. The consent agenda is approved by unanimous consent. Okay, item number 4, Historical Benefits Review Project. Executive Director Doris Rentschler, please.
Thank you, Chair Land. The report showing the corrections process for December is in your packet. If you have any questions, I'm happy to answer it. I would like to mention that we have requested an extension of the compliance completion date, and that has been submitted to the IRS and is pending review.
Is there anybody who would like to discuss this item for discussion? Is there any public comment?
There is no public comment.
Okay, thank you. We will now move on to item number 5. And 5A, this is International Equity Structure Considerations and Staff Recommendations. Robert Ravelis.
Trustees, you have a memo before you where I went over some of the staff considerations process that we followed working with Callan on this review. A lot of it was very similar to the domestic equity structure review. And I'd be happy to answer any additional questions. I guess we were hoping for selection of the passive index manager today, and we were hoping trustees would give direction on which strategies you'd like to bring back for further consideration at probably the January meeting. That's what we were hoping to do. I think my mic is on. Yeah. Is it right? I hear it. I could talk louder. Or try to get closer, louder. I laid out some metrics and portfolio construction on each of the strategies. And Callan's also here, and we can go through their presentation. There's a number of extra materials that supplement my memo. And Greg and Claire and Hannah are here. We can all chat and talk about thoughts on this.
So this memo was not an action item, but the presentation from Callan regarding the international index options would be an action item. And so I think the next item is just to move on to item 5B, Chair.
Okay, so be it. Let's move on to item 5B.
Yeah.
Great. Thank you. It's good to see you all. So we prepared a summary presentation, and we'll walk through that, help you make a few of the decisions that Robert alluded to. So to step back a little bit, we did our big asset allocation study, came up with a target asset allocation, how much money you have in U.S., international, bonds, real assets, etc. And then we've been going through each of the asset classes and determining, should we change the way we invest structurally in these different categories. And we stopped and we started focusing on international equity. And when we did that study, we decided to make a few structural changes. So that decision was made. And now we're coming back to you, okay, if we make that decision, we need to hire some new managers, eventually get rid of some of your existing managers. And today's the first step of deciding which of those managers we might hire and which ones we might want to interview at either the January or February meeting, depending on how much volume you want, how much investment topics you want at each of these meetings on a go-forward basis. So I know we probably bludgeoned you with a lot of reports, and apologies for that. But the summary presentation should be here to help us just walk through and make a decision collectively about who we think we should either hire on the index side or who we should interview for international small cap and emerging market equity. Unless there are questions, maybe we could just hop right into it. So the summary presentation, Robert has it up on the first slide here. It restates that back in August, we took a look at the way we invest within international equity. And the bottom left-hand chart here shows our current manager allocation. And we have 4 managers who invest predominantly, though not exclusively, in developed markets and in large cap. And then we currently have 2 managers who are kind of our specialty managers. 91 and T. Rowe Price. 91 invests in emerging market equity exclusively, and T. Rowe Price invests in international small cap exclusively. When we did our study, we made the decision that we only want to spend active risk, have active managers in emerging market equity and international small cap on a go-forward basis. And we're going to invest only in an index fund in developed large cap market on a go-forward basis. Okay? So on a go-forward basis, the pie chart's going to look like what we have on the right. So we're going to have about 2/3 of the assets in an index fund, about 27% in emerging markets, because that's what the market is, that's what the index is, right? We're not taking a bet for or against emerging markets. Then we're going to have about 10% in small cap. Now, when we invest more money in emerging markets and we have small cap, we thought we should increase our manager diversification. So we're going to add a manager to both of those 2 categories, emerging market and small cap. And at a future meeting, we'll interview those managers and decide exactly which one we want. So today we want to decide, well, which ones do we want to interview at a future meeting? So it's not a final decision that we have today for small cap and EM. Now, today we might be in a position where we're willing to make a decision on the index fund. There are fewer considerations there. So today we might be able to make that decision on an index fund. So in a little bit, I'm going to hand it off to Claire and Hannah, and Claire's going to talk about the emerging market equity search, and Hannah's going to talk about the international small cap search. So that's the framing, that's what we're doing. Now, we walked through the search process, and you've done searches with us before. So we have an open architecture model where we screen the universe, look for all candidates out there that might be a good fit for you. We use our manager research team to help us narrow down that list. We have 40 researchers out there that just track active managers and passive managers and help us discern who is the best manager out there for a given client situation. And we go through this process, and Robert's been very involved along the way. So he's been in the loop about all the recommendations that we are preparing and the thought process we have as to why we have those recommendations. And I'd also like to say, I think Robert's memo was very good. So I thought it was a very good summary for you to read as well. And that brings us today to these 3 different searches, right? So I'll flip ahead to slide 4. We went through the process to look for an index fund, and there are only so many index fund providers out there. And a few things we focused on is who has a vehicle of size, who has an attractive fee, who does a good job of tracking the index, and who has a non-lending strategy. So we did have a bias to look for a non-lending strategy for you, because we just think the risk-reward trade-off of lending versus non-lending, it tilts more towards non-lending. So we wound up and really focused on these two providers, Northern Trust and State Street. And you'll see that all-in expense ratios are pretty much within a basis point of each other. So they're very, very close. And when the fees are that close to each other, other factors might become more important, right? Such as the size of the vehicle and the historic tracking error experienced by those different strategies. These are essentially a tie, so let's go ahead and look at some other things that might be a little more important for you managing risk on a go-forward basis. On slide 5 here, we have the two candidates, Northern and State Street. And you'll see we have their returns versus the index that they're gonna run against. And notably, this index is called the MSCI World XUS. What that means is it's the countries outside the United States, XUS. It includes Canada, so it's not EFA. But it excludes small cap and it excludes emerging markets. That's what world means as opposed to all country world. So this index fund that we're looking at here excludes those other two pieces that we're going to have dedicated managers for, international small cap and emerging markets. There's another index out there called the MSCI ACWI All Country World XUS Index. That includes all that stuff, not small cap though, and that's your benchmark for your total plan, okay? So that's why we're looking at this index fund, the MSCI World XUS, and we've got these two providers. And you'll see over the long run, SSGA State Street, the 7 and 10 year returns are very close to Northern, but near-term performance is just a little bit better, right? All else equal, we'll take that. And then on slide 6, we show the rolling tracking error. So this is a rolling 3-year measurement of how close are you to that index you're meant to match, right? So Northern Trust here has a tracking error of 2, and these are in basis points. And then State Street is 1.7. So State Street, the way you interpret this is State Street's done a little bit better job of more consistently being close to the index over these rolling 3-year time periods. Additionally, the State Street fund is bigger, so little cash flows coming in and out of that fund are less likely to really drive the performance of it. We think that's a good thing, right? As small funds that are smaller, if a new investor comes in or a new investor goes out, there's a little more positioning and transacting that those fund managers have to do, and it could possibly lead to tracking on a forward-looking basis. So with all of that, we thought it was reasonable to go with State Street on a go-forward basis, and if you're comfortable with that, you can make the decision to say, I think State Street's a good candidate for us. And then eventually when we transition the portfolio, probably in the first quarter of next year, that 2/3 allocation, the 63% allocation to index fund, you'll be ready to go with that. So if you're ready to make that decision, that's good. And then in the next couple meetings, we could start focusing on, well, who are the, exactly which international small cap manager we want to hire, which emerging market equity. So I think the question at hand is the State Street versus Northern, or any other questions you might have about the process and what brought us to this record.
Trustee Cromer.
I'll bite. From my review of your documents, it appears that State Street's not just larger, it's significantly larger. Is that accurate?
Yeah.
Yeah, I mean, it's much, much, much larger.
Yeah.
And from the documents provided, it seems that State Street is historically, when it's a better market, it is slightly better than Northern Trust. And when it's a struggling market, it's slightly worse on a few of those fiscal calendar years. Or, I'm sorry, the calendar years. So, but the size of the fund and accuracy of their tracking error is what's leaning me towards State Street as well.
Is there any other comments? Anybody else have anything to offer on this item?
I just have one question. Do you believe that the tracking error is related to the size? It's kind of diminished the,
I think the size means a lot.
okay.
And with cash flows, that can be certainly one of the determinant factors in it.
Okay.
Yeah.
I would jump in and say it's probably related to the pricing vendors that they're using. So, you know, international, yeah, they're international developed markets, but they're still not, you know, U.S. markets.
Well, in reality, if you look back at the last 10 years, I think it would have to go to 10 years. The last 7 years are all within our expectations or our set rate of return of what we expect or better, and obviously significantly better. So they're both good funds from what I can see.
Absolutely, they are.
Do you share the same direction to us,
Yeah.
Robert?
Yeah, and I tried to lay some of that out in the memo. I mean, it's really the same things that Callan's mentioned here. You know, we're relying on the construction of the index from MSCI, right? The 22 of 23 developed markets, and then we're hoping that State Street can perform and be consistent with that benchmark. And both Callan's metrics and the metrics that I provide in my memo show that State Street's able to actually implement that strategy in a more consistent, longer term fashion. I mean, they're both long term, but and we're sort of splitting hairs even too. I mean,
Yeah.
They're both pretty close. They're both pretty strong. But in terms of, you know, that longer term consistency, by my review, State Street is a little more stable, which I think provides a better base for us to add these other layers on top of it.
And from all the metrics, it looks like they both were better than the MSCI.
Yeah.
In the comparison you provided. So
Yes.
is this a direction to staff or is this an actual motion?
This one would actually be a motion. Staff's recommendation, and Callan would be to select the State Street Developed Market International Fund for the index portion. And we'll talk about the other two sections separately, but the only action item would be selection of the index manager.
Chair Land, I'll propose a motion if you'll allow.
Sure. I would second that, but I did want to ask a question as this relates to the first slide. There's new index of 63% under the new pie chart. Would this manager be occupying all 63% then?
Yes.
Okay.
Yeah.
And in real dollars, how much is that? Approximately, I mean.
125 million.
Or more than.
So we're making a very large shift here to a new manager.
Yes. Yeah. And you're essentially you're eliminating 4 other managers as well. Or will be.
Right.
Actively managed.
Yeah. So it's 120 million would be in this new index fund.
Okay.
In a way that mirrors similarly what we've done in the domestic side with an S&P 500 for the large allocation, and then do some selective active management in the small cap arena. And this is sort of aligning our international approach similar to the position taken on the domestic side.
When I was reading through this, I was having a lot of trouble finding a lot of daylight between these two managers.
Yeah.
And you guys, it seems like you were leaning towards bigger is better, and there is clearly a large distinction there. In general, for the other items that are on the agenda today, is bigger always better?
No.
No. But in this case, bigger is better.
Yeah, this is a scale business. This is, yeah, and there are a few like really large index fund providers. And so scale is really important on the index side. Not so much. Scale can work against you in small cap and sometimes in EM. Like being really too large to buy a small cap company can work against you. The opposite is true on the index side.
Okay, and I believe there is a motion. Is there any other discussion?
I just have a quick question why Robert jumped to this slide. Is there,
Well, I was showing the allocations.
okay,
So trustee Land was asking what that allocation could be, and, you know, this depends on the point in time, the day we do it, but it's going to be somewhere around 120, 125 maybe million right now today. Of course, we're not going to do the transaction today, but that'll be a process in the future. But this gives you a sense of what the dollar amount we're talking about.
Right.
So 120 million into a $25 billion strategy vehicle, you know, we're not going to move the needle a whole lot, and that's definitely something that we want.
Okay. And we do have a motion. I'm not sure if anybody seconded that motion.
If I can state the motion
Okay,
to select
restate the motion.
State Street Global Advisors as our index fund. Sorry, go ahead.
I'll second.
So we have a motion and a second. Roll call vote, I believe. Public comment. Thank you.
There does not appear to be any public comment. I'll proceed with the roll call. Ms. Cavanis? Aye. Mr. Cromer?
Aye.
Ms. Harris? Mr. Swope?
Aye.
Ms. Pierce?
aye.
Mr. Land?
Aye.
Approved.
Okay, so I believe that is item 5A sub 1. We're going to improvise and have a 5A sub 2.
Yeah.
Correct? Okay.
Correct. So the next step is we're going to take a look at your emerging market equity and then the international small cap managers. And you already have two managers, one manager in each of those categories. And they're both doing a really good job for you. They're both in good standing. So we just want to add one other manager in each category to complement your existing and give you more manager diversification. So that's our objective now, and we just want to determine, you know, which managers we want to come back to interview at a future meeting, whether that's 2 or 3 candidates, and we'll defer to you on that. So with that, I'm going to hand it over to Claire, who's going to. Oh yeah, Robert shared the fees page quickly at the back of the presentation, and that showed where we have 120 million going into the index fund, but it also shared a pro forma fee expectation. Because you're moving to index and you're only spending active risk in a couple categories, the total fees are going to go down. But those inefficient markets individually have a higher expense ratio than the developed market. So kind of like the sticker, optically, it looks like some of these strategies are, and they are more expensive than some of your existing large cap developed market. But if you look at the whole, the fees are going to come down meaningfully. So right now, weighted average expense ratio is about 75 basis points, and we think it's going to be in the mid 30 basis point on a go-forward basis. Having said that, some of these, the emerging market equity, international small cap, you know, those fees come closer to 1% because of those niche markets that we're operating. And all of them are reasonable fees from our assessment, but they are a little bit higher than, you know, the cap guardian fund that we're going to be out of. So just wanted to share that and put all of that in context before we get to the full fee section. Okay? All right. Claire's going to talk again.
All right, so moving on to the 2 active manager searches and starting with emerging markets. So before we jump in, I do want to acknowledge, Greg mentioned that we worked very closely, of course, with our global manager research team on these searches, Robert joining us for many of the steps along the way, and we're actually joined today by a member of our global manager research team. So Lauren Mathias is on the phone, certainly a resource if there are any questions for Lauren, or of course if we need to phone a friend too. So did want to acknowledge that Lauren's on the line as well. The other thing I want to say before we jump into the individual candidates is that all of the process that we went through to bring you these 3 finalists in both cases led us to 3 finalists that we think are all good choices. So as we go through each of these managers, we're looking to differentiate to really try to select the best manager for your portfolio, but we don't think that there's a bad choice on the page. So I did want to say that up front as we start to kind of split hairs between the finalist choices. So diving in here, emerging markets. The 3 finalist candidates that we brought today are Artisan, Fidelity, and RBC. RBC stands for Royal Bank of Canada. This is the asset management arm of Royal Bank of Canada. All 3 of these managers are benchmarked to the same index. That's the MSCI Emerging Markets Index. And you can see the fees here for each of these 3 strategies ranging from 65 basis points to 84 basis points. As Greg mentioned, all of these are reasonable for the strategy, but a 20 basis point difference among the group. And then on the next 2 pages, we have a summary of each strategy. So going through kind of highlights of the organization, the team, the strategy, and then the Callan summary opinion on the far right. So starting with Artisan. Artisan is a fundamental portfolio, and I should have noted all 3 of these strategies are fundamental. So these are questions.
I wanted to have you comment on the no cap on the Fidelity. I know we're talking comparatively small percentage, but I would appreciate a little elaboration on the no cap provision.
I will actually turn that to my phone a friend, to Lauren. She'll give you a better answer there.
Yeah, thank you for the question. So we were also interested in that as well. And so while Fidelity wasn't able to give us an absolute cap, they have given us a historical range, which is within range of what is currently listed on the page. So that 5 basis points has been where it's rested for quite some time. So we don't have reason to believe that would increase significantly. Certainly there's substantial assets in the fund, and so that can be a factor in terms of the operating expense, and it is a healthy level. So we don't anticipate it going beyond that dramatically, but we can certainly follow up with more details in a conversation with Fidelity, but that's what they've shared with us so far.
Then on Artisan, there is no comment on the particular operating expenses.
Correct. In this case, they are offering us a founder's share class that does not include an extra level of operating expenses. So the total fee is the same as the management fee.
Lauren, so turning back to the next page, starting off with Artisan. Artisan is the emerging market strategy is led by a key portfolio manager, and she's supported by a very seasoned, stable team of 6 dedicated analysts. So that's the team that's running this strategy. And the strategy is a bottom-up fundamental portfolio. So they're building this portfolio by doing research on stocks, companies, and building the portfolio from the bottom up, picking stocks to build the total portfolio. It is a relatively concentrated portfolio. so holds about 55 to 80 names, pretty low turnover, and it has a bit of a growth tilt. So we'll see that when we look at the chart in one of the charts in a couple pages here. You'll note that sustainable is in the name. So that is a consideration as they're assembling this portfolio. They're looking at sustainability of fundamentals, of earnings, as they're picking stocks to be in the portfolio. And they're also a little bit underweight China. So that's kind of a structural component of the total portfolio. Fidelity, the next firm on the page here, bottom half of the page. This is a research portfolio. So again, a fundamental portfolio, but it's led by one portfolio manager who assembles the portfolio, leveraging the deep research team at Fidelity. So they have research analysts who fundamental bottom-up research, they rank stocks, and then the portfolio manager assembles the portfolio using those analyst rankings. This strategy tends to be country and sector neutral. So that's one way that they control risk in the portfolio, but it also means that alpha in this strategy tends to be driven by stock selection. So that's where they're trying to beat the benchmark, is through their bottom-up stock selection. It is a slightly more diversified portfolio, so holds about 100 to 130 names, slightly higher turnover in total. And one thing you'll note as we start to look at performance for the strategy is that it did actually struggle a bit in the last 3 years. Longer term returns are still very solid, in good standing, but the 3-year return has underperformed benchmarking. And then the last candidate outlined here on the next page is RBC, again, the asset management division of Royal Bank of Canada. And this is a multi-PM team. So there's 7 total portfolio managers, 3 analysts that run this strategy. Again, a fundamental portfolio, but takes a slightly different view. So the portfolio is assembled more from the top down, which means that they're really looking for themes. They're looking for global themes, and then trying to identify countries and sectors, stocks ultimately, that will benefit, they think will benefit from those global themes. So still doing bottom-up fundamental research, but really assembling the portfolio more from kind of a top-down perspective. This is the most concentrated from when we think about the total number of names in the portfolio, about 45 to 65 names, and pretty low turnover again in the portfolio.
Chair, if I can jump in.
Yes.
So in looking at the summaries you provided, it looks like both Fidelity and RBC are documented as being viable for standalone or multi-manager structure, and Artisan, it just says, is viable for standalone given the core growth portfolio characteristics. We are talking about interviewing numerous of these potentially to accompany the 91 investment we currently have, and that's your recommendation, correct?
Mm-hmm, mm-hmm.
So does that concern you with that fact that it would be a multi-manager structure?
No, and we would kind of consider these, no, it doesn't.
Okay.
We think all of these would be good complements to your
Okay.
existing manager. They can stand alone or be paired with another, so.
Okay, I just wanted to
no,
make sure, because that was the one caveat to Artisan. It didn't have the same language in that category there.
Yeah, thank you for that question. No,
Trust-
all,
Trustee Swopes?
Yes. I wanted to have a little perspective on, it's sort of nice for numbers, 178 supported analysts versus 7 dedicated. Could you maybe elaborate on that type of philosophy? Because, of course, we don't expect 178 analysts to be working on our portfolio, but I would like a little elaboration on the reality of who is doing the analysis.
sure. So I think the way I think about it is differentiating the size of the team and how they leverage that to ultimately get to the portfolio that that delivers returns. So for Fidelity, I described it as a research portfolio. To your point, 178 analysts aren't, getting together to pick the best stocks all together. They have regional and sector specialists, and those analysts have their individual portfolios in those regions and sectors. They rank the names that they cover, and then the portfolio manager at the top level is using those rankings that are generated by the analyst, so relying on that deep research team. That's different than an Artisan or an RBC, which are smaller teams working more closely together to do the bottom-up fundamental research on individual names to select for the total portfolio. Does that help?
So I would jump in and say Fidelity is using their entire research platform, a large group of, little buckets, and they're sort of filtering all that information up to the top, and the team is sort of selecting that. On Artisan and RBC, they have, a smaller group of individual people that are focused on those particular strategies. So that's why, you see such a big difference is there's small teams versus Fidelity having this large research platform.
Are there any other questions? I have one quick question in regards to the turnover metric. On Fidelity, it says expected annual turnover of 60 to 100%. Now, 100% is pretty high. That means in any given year, they might sell every stock that they have and completely reinvest and have a completely different fund structure than they did at the beginning of the year. Is that concerning?
No, but Lauren, can I turn it to you to talk a little bit about expected turnover for an emerging market strategy?
Yeah, absolutely. So I guess I'll kind of piggyback on what Claire was discussing about the different ways that each of these teams invest. Because of the way that Fidelity invests, which is these highly diversified group of securities selected by this broad research platform, the portfolio manager is constantly reviewing and refreshing those ideas. And as rankings change or analyst opinions change, then the weighting in the portfolio is going to change as a result. And so those things can happen more frequently than a Artisan or an RBC, which is a slightly more concentrated portfolio, a portfolio that this more narrow group of professionals doing deep research are looking to invest kind of over the longer term, in contrast to kind of Fidelity, where these rankings may change over a shorter time frame as a result of kind of the analyst-driven approach. So I wouldn't say that one way is better than another. It's just different. And so that is a distinction of this strategy versus the others.
I'll also jump in again and say that we're going to see that in the other international small cap manager strategies. So we're going to see higher turnover on average. That's another feature of computer-based quantitative strategies. They look at, without getting too deep into it, they look at hundreds of different factors, risk factors, and those change all the time. Every month they could change, or every 6 months. And so that necessitates turnover. We're a little less concerned about turnover. We're not a taxable investor. So on the taxable side, that may be something of high concern for you, depending on what strategy you have and how much money you've got invested in it. But that's less of a concern for us. It's just something that we want to know about their process, that their process involves a lot of buying and selling, or it involves less buying and selling through some of this fundamental research.
If I can, I was looking at the same thing, and when I read that, I think I made an assumption that the turnover rate might directly correlate to higher levels of volatility in that fund, but it doesn't appear to do that when you look at later pages and graphs, that Artisan seems to have a higher volatility rate and standard deviation.
Yeah, oftentimes a more concentrated portfolio, kind of a higher conviction portfolio, can have higher volatility. So
there's fewer securities there, and so the price action of fewer securities can cause the total portfolio to waver around more than a larger, than a larger holding portfolio.
And Artisan is significantly smaller than the other two we're talking about.
In terms of constant number of names in the portfolio.
I think in overall
Oh,
fund.
overall assets,
Yeah, assets, yes.
it is smaller than the other.
In terms of the number of holdings, RBC and Artisan are closer. They're definitely, fewer holdings.
And before we move off of the turnover topic, I did want to also mention that turnover isn't always just full name turnover. It includes if the portfolio manager decides to add to a position or decrease a position. So it includes kind of all of the transactions that might take place with a portfolio holding. So it's not only full scale buys and sells.
Any other questions so far? Okay. So we've included a number of charts here to try to slice and dice the style and performance of each of these managers. But starting here, this is what we call a style map, and it looks at kind of the style plot of each strategy. So growth versus a value tilt, a style tilt to any of the strategy, and where they plot from a cap size perspective as well. So you'll see 91 there, pretty solidly for portfolio, and we're looking to complement that with another 4 portfolio. Each of the 3 managers here, we think really fit the bill. Any of them, as I mentioned before, is going to be a good complement to 91. But the one thing that I note here is that Artisan has a little bit more of a growth tilt to it. So that from a stylistic perspective is just something to note overall. Not a concern, again, we think they all would be a good complement to 91. And then the next few pages get into performance. So what have we seen each of these strategies deliver from a performance perspective? Starting here, we have annualized cumulative performance ending September 30th. All of these strategies have delivered solid performance over longer time periods. So over the last 10 years, we've seen all of these strategies fare well versus the benchmark and peers. As I alluded to earlier, Fidelity has seen some performance challenges in the last 3 years. So that one negative number on the page does stand out. RBC, on the other hand, has turned in performance over the last few years that's pretty hard to ignore. It's been top quartile, and we'll see that come through in the next as well. We have calendar years on the next page, but I'll flip ahead to the following page, which looks at rolling 3-year excess returns. So here we're really looking at the consistency of the performance patterns that each of these strategies have delivered. So because we're looking at excess return, we're looking at return for each strategy versus the benchmark. So on each of these charts, there's a 0 line and then a colored line that represents the strategy return over a 3-year period. Any point on the colored line that is above the 0 line represents a 3-year period where the strategy outperformed the index. The gray distribution then represents the peer group. So any point on one of those colored lines that lands within that gray distribution represents a 3-year time period that the strategy landed within the distribution of the peer group. The white line is the median of that peer group. So there's a lot of information that's kind of captured on these rolling 3-year return charts. But again, to me, the real takeaway is consistency of performance. So I'll actually start on the bottom right, where we look at the rolling 3-year excess return of 91, the manager that you already have, the manager we're looking to complement. And the key thing that I notice is this has been a really good pick. So 91 has delivered pretty consistent performance versus the benchmark and peers over a rolling 3-year time period. Pretty consistently above that 0 line and somewhere around or above the white line, which is the median of the peer group. Looking one chart above that on the right-hand side, we have Fidelity. The orange line represents Fidelity's rolling 3-year return, which was very consistently above the index and above peers until 2022. So that's what I mentioned. They hit a rough patch in performance in the last few years. So when we looked at performance as of the end of September 30th, a couple slides ago, we saw that their rolling 3-year return was pretty hindered. There was a headwind from the most recent 3 years of performance. And you can see that come through on that orange line, which is below the 0 line, so has underperformed the index and peers over recent time periods. As I mentioned before, though, still their longer term numbers are solid, which is why we brought them forward as a candidate today. Moving one chart to the left, top left chart, that's Artisan. Artisan has delivered rolling 3-year performance that's pretty consistently within that peer group. But as I alluded to, or actually I don't think I mentioned this, but did have a performance struggle in 2022. So they did underperform in 2022, but then they rebounded. So when we look at performance as of the end of September 30th, you don't really see that, but it's worth calling out. But again, pretty consistent performance. I think we'd be happy with that performance pattern if they had been in the portfolio. And then rounding out the group on the bottom left, we have RBC, represented by the green line. And again, RBC delivering performance pretty consistent versus the peer group, and over most time periods above the 0 line, so delivering 3-year rolling returns above the index. And in the last, let's see, 7-ish years, really consistently, well, I guess over the last 10 years, the whole time period shown here, pretty consistently above median. One slide forward, we continue to slice and dice performance, look at it as many different ways as we can. So here we're looking at rising and declining periods. I think the key takeaway here is that all of these managers have delivered performance within kind of a reasonable risk tolerance. The bottom chart, up market capture and down market capture for each manager. The one thing that stands out to me there is the RBC line. So RBC down market capture less than 100% tells us that in down markets, they have tended to protect, so outperform when the market is down. 103, 104-ish for their up market capture tells us that they have outperformed the index in up markets, but by a little bit less than Artisan and Fidelity. So they've protected in down markets and outperformed in up markets, but maybe less than the other two candidates. So that's kind of a differentiator of their performance pattern over the last 2. And then on the next slide, we look at correlation. So kind of coming back to this idea of we're looking for a complement to 91. How did the performance patterns of each of these 3 candidates complement the performance pattern of 91? Are they, very similar? Are they somewhat differentiated? And all of these numbers tell us that, they're all pretty well differentiated. They're pretty good complements to 91. If I'm focusing on the bottom row here, I should say, so that's looking at correlation, excess return correlation with 91. If any of these numbers were 1, that would indicate that their performance patterns were perfectly correlated with 91. But here we have all returns that are closer to 0. The highest return here, the highest number here, though, is Fidelity at 0.3, telling us that the performance pattern of Fidelity may be a little bit more correlated with that of 91 versus the other 2. And then the last 2 slides that I'll hit on map risk versus return in 2 slightly different ways. So here we have risk measured by standard deviation. So we're looking at absolute return volatility. That's on the horizontal axis. And then on the vertical axis, we have returns. The crosshairs here represent the median of the peer group for each statistic. And then the ellipse captures the majority of the data points within that peer group. So my big takeaways here are that Artisan and RBC over the last 10 years have both outperformed the median of the peer group pretty substantially as well as the index. Fidelity has outperformed the index, but landed just above median within the peer group. That's from a returns perspective. And then when we think about risk or total volatility, Artisan has had the highest total volatility and RBC the lowest. Fidelity, again, somewhere near median versus the peer group. And then one more slide ahead. It's the same idea, but we're looking at risk and return relative to the benchmark. So tracking error versus the benchmark. Volatility relative to the benchmark, really. And then excess returns, so returns over the index on the vertical axis. So here we see that all three of these managers have delivered returns above median of the peer group, above the benchmark over the last 10 years, with less tracking error than the median of the peer group. So again, all good choices. RBC and Artisan have delivered higher returns, again, with that lower volatility than Fidelity when we're comparing the three. Okay, I'm gonna pause there. That's kind of our overview of the three candidates. For any additional questions from the board, I think, as Greg mentioned, you can choose to interview all three, or if you want to interview two, we think there is an opportunity to maybe eliminate one at this stage and decide to hear from two of these three managers.
And ultimately, we would be choosing one.
Ultimately choosing one, yes.
Does
And
anybody
so
have any questions?
I'd like to
comments?
at least just jump in real fast and remind trustees that in my memo, I had some portfolio construction overview and limits for these three strategies. And so my hope was in providing that you could sort of take this information from Callan and look at some of those construction guidelines and decide what you feel comfortable with, and how willingness, your own willingness, I should say, to take risk in the EM area.
The managers would come back probably January or February, was that the idea? So the board would have an opportunity to actually hear from the managers running the specific strategy, where you would get more information directly from the horse's mouth, so to speak, before making a decision as far as the complement you want to add to the portfolio. This is your opportunity to say, yes, we'd like to hear more from this vendor or that manager.
Are there any comments? Trustee Swope? I was beginning to think this felt a little bit like an elimination round. And I also had leaned toward Fidelity on many of these slides, coming up a little bit short of both RBC and Artisan. So I would agree that maybe we wouldn't need to even interview Fidelity, but I would also wonder if that's in conflict with anything that Robert was saying about his analysis on the first item. I did not see a correlation between, I wasn't smart enough to pick that up.
My own biased view here is that Fidelity isn't different enough to merit bringing back for review.
And I think that there was a chart at some point to back that up a little bit, where they were almost completely contained within the 91. I mean, there's a lot of Venn diagram intersection on page 10 between 91 and Fidelity. And I don't know if that's agreeing with what you were saying, but that's kind of the impression that I got as well.
There are so many different metrics to look at, and I have so many other metrics that I didn't provide the board, and, I know Callan has them also that's not provided here. The thing that I think about for these subcomposites, one of the biggest things that I think about is how's it going to pair with who we have now. And so one of the things that I look at is those longer term correlations between the two strategies, and how diversified are those return streams. And when I looked at Fidelity, Fidelity is a great option, great choice, but my opinion is that it wasn't diversified enough, really. Similar level of holdings, similar returns, similar standard deviations, and we can see that on some of the yearly return numbers that Callum provides also. They're usually within, 10, 15 percentile ranks of each other. And so, that's one reason that I think it's probably worth to look at some of the other strategies closer.
Are there any other board comments? And would we need a motion at this point, or just direction from staff?
Just direction.
And I'm in the absence of other comments, I would say that that considering this elimination round and removing Fidelity from the manager, the next round, is the direction of staff that we would give, I believe.
I just have one other comment. I agree with interviewing both RBC and Artisan. I just do want to make the trustees aware here. We did have at the Board of Supervisors meeting a significant public comment regarding Royal Bank of Canada. Now, I don't think that should sway any decisions on trying to interview, but we may have an increase in public comment around the Royal Bank of Canada.
I noticed that as well, and I did watch that board meeting. When I looked at it, though, the items that the public were objecting to were not necessarily this exact portion of the Royal Bank of Canada's investment portfolio. I don't believe that the items they were complaining about would fall into this particular asset, their strategy. They might, though, and it is there.
This is the asset management firm, so this is a company within the bank.
Right.
It's not directly, the bank bonds in that instance. So, yeah, it's kind of the same company in a sense at the highest level, but this is the asset management arm running a particular EM strategy.
Okay, I believe at this point, taking into consideration what Trustee Pierce says about that, we are still going to give direction to staff to eliminate Fidelity and to have, to bring back the other two, Artisan and RBC, for the next round of interviews. And that's item 5A2. Do we have a 5A3, or are we moving on to, wait a minute.
Hannah's going to cover the international small cap. We're looking for a manager to complement our existing manager in that arena.
Okay.
Great.
Thanks, Claire.
Are you?
This is 5B.
Yep.
Thank you. Can you go to the summary presentation, do you mind, Robert?
Oh.
Slide 9.
Oh, okay. I see.
As Doris mentioned, we're looking for a complement to your existing international small cap manager, T. Rowe Price. We can start on, yes, I believe it's slide 9. Yep, thank you. So the three candidates we've brought today are AQR, Brandis, and Causeway. So all three of the strategies we're looking at are international small cap equity strategies. Within the actual product, the vehicles that are proposed are all institutional pooled vehicles. And then we also show the product AUM, vehicle AUM, and the investment management fees. From a product and vehicle size standpoint, all of these options have a good amount of assets, so no concern with size. And then from a fee perspective, AQR is all in at 95 basis points, Brandis at 75, and Causeway a bit more expensive at 1.10. We can walk through the options on the next slide, looking at a summary of the org, the team, and strategy in our summary opinion. So starting with AQR, this is a quantitative firm. AQR stands for Applied Quantitative Research. The firm is independently owned. They have about 600 employees, 7 offices globally, and they're headquartered in Greenwich, Connecticut. They have over $100 billion in org AUM, and they do mostly alternatives and equity strategies. From a strategy perspective, this is a quantitative strategy, so it uses a quantitative model driven by value and momentum. It employs a combination of top-down and bottom-up multi-factor to generate a portfolio. Typically holds between anywhere 400 to 800 names. As of the third quarter, it had about 435. And it has a high turnover, about 50 to 150% annual turnover. But it's a very diversified strategy, has really good risk controls, and it's dynamic. It can move with the market. And then opposite of AQR really is Brandis, which is the next manager. This is a true fundamental value manager. They're also 100% employee owned. They have about 30 billion in AUM. They're based in San Diego, about 200 total employees. They do mostly non-US and global, but are known for their value strategies. So they, opposite of AQR, are really bottom-up, fundamental, deep value manager, really that seek to identify undervalued businesses trading at a discount to their relative or intrinsic value. For this strategy, tracking error can be slightly higher. They tend to hold names a bit longer, waiting for their values to be repriced, so it can lead to periods where they may underperform. But over the long term, I think this strategy especially is important to have a long-term perspective. And it's more concentrated, about 60 to 80 names, and because of the lower amount of names, it has a lower turnover, about 20 to 40% turnover. And then kind of landing somewhere in the middle is Causeway. This is another 100% employee-owned firm, about 110 employees, about 53 billion in AUM. And Causeway uses a combination of a quant and a fundamental strategy. So about 90% is a quant bottom-up inputs, and then 10% is kind of top-down, so looking at country and macroeconomic factors. They have about 120 to 200 stocks, annual turnover about 100%, and they utilize a fundamental team to kind of enhance their qualitative team, which is kind of unique, a little bit of both there. On the next slide, we can kind of get into how these strategies look compared to one another. This is a style map looking at the capitalization spectrum on the y-axis and style on the x-axis. You can see the benchmark in red, MSCI Equity ex-US small, plots core, and we currently have T-Row, which is in that gold color. So that is our international non-US manager that has more of a growth bias. So we're looking for something with a value bias to complement it so that together they kind of plot core. So comparing AQR, Causeway, and Brandis, Brandis is the most value, the deepest value, and they also plot a little bit smaller on the capitalization spectrum. And then AQR is still value, but more core, and then Causeway plots somewhere in the middle. The next few slides look at returns. For the trailing time period ended September 30th, all 3 managers have had top quartile performance over every single time period, except Causeway for the most recent quarter underperformed the benchmark, but was really due to its IT exposure, which sold off during the quarter. But other than that, every single time period is really top quartile. So as we've mentioned throughout this presentation, you cannot go wrong with any of these managers. And I think in order to narrow it down, we were really splitting hairs. But really strong returns over all time periods. Brandis exceptionally hard to ignore, but last year up 45%, ranking, third, really top decile manager. But I think it's also important to point out on the next slide is that there's volatility underneath those trailing long-term time periods. So Brandis, like I pointed out on the last slide, top third manager, but if you look at, for example, 2019 and 2017, they were at the bottom. So there are often swings in performance, which I think as a committee or a board, it's good to be aware of, that at times you can be out of favor. So keeping that long-term perspective is really important. But again, all managers have done really well. I think the next slide does a good job visually explaining or looking at rolling 12 quarter excess returns. So I guess one thing I'll point out, relative returns, thank you. So Claire did a good job of explaining these charts. The colored line, if it's above the 0 x-axis, that means it's outperforming the benchmark. And the gray distribution is the peer group, and the white line in the middle represents the median. So for AQR, you'll notice that for most periods, they stay within the gray distribution, and they're pretty consistent compared to Brandis, who is in and out of the peer group distribution. And you'll also notice from around 2017 to 2021 until value turned back into favor, they were at the bottom. So completely outside of the peer group. Causeway, a bit more consistent, landing inside the peer group, but has had really great recent performance. And then we also show T-row your complement, which I think is good to point out that you'll notice T-row above at the top of the peer group. And then it does fall in 2022 when growth was out of favor and we saw interest rate increases. So I think that does a good job of showing how value and growth together are complementary to one another, moving in different directions here. On the next slide, we show another way to split performance, looking at rising and declining periods and up and down market capture. All managers have outperformed the peer group average when it comes to up market capture, doing well when value does well, and then also providing a bit of downside protection when value isn't performing as well. Correlation, another important metric to look at on the next slide, showing the excess correlation versus your existing manager T-row price versus the 3 candidates. So a correlation of 1 means that they both go up in the same direction. -1, they're both moving down together. So you really want 0 would be completely uncorrelated, so closest to 0 as possible. For T-row, that happens to be AQR, but Brandis and Causeway are not far behind. They have a 0.3% correlation. So again, all 3 of these would be a great fit as far as correlation goes. The next 2 slides look at risk and return and excess return. So for this slide, we look at returns and risk, so standard deviation on the x-axis. And you really want to be in that top left quadrant, which AQR, Brandis, and Causeway all land in, with a similar amount of risk and a high amount of returns. And then the next slide looks at tracking error versus excess return. So this looks at how you outperform the benchmark and how different you are from the benchmark. And AQR has the least amount of tracking error compared to Causeway and Brandis. Brandis, you'll notice, is farther out on the spectrum when it comes to tracking error, and Causeway lands somewhere in the middle. Are there any questions on the individual managers, or do you feel like interviewing all 3?
Would any board member like to make any comments or discuss this item?
Chairland, I'll say that personally, I think AQR is probably the most complementary to what we're already invested in, so that's a given to me that I want to see them here. I'm now comparing and contrasting Brandis and Causeway, and from most of the data, which is probably a gross summarization, it seems like Causeway's probably hitting more singles and an occasional double, and Brandis is extra base hits and home runs, or they're striking out. And that concerns me a little bit with the volatility of this, but that might be an oversimplification of what I've seen, but that's where I'm looking right now. And if you disagree, please speak up.
Well, so I would comment, at least towards Brandis, they don't have any specific constraints on tracking error at all. They don't care. The other two strategies, they definitely use that as a risk control, and that is also something that I mentioned in the memo in those notes there. I think the relative strength of all three of these managers are quite high. From my review, AQR and Causeway together as a composite are almost the same sort of return stream. They're the same, they're very similar in terms of their volatility. But to be fair, adding Brandis, does add a little bit of that tracking error, but it's not that much more. I think I want to say it was something like 120 basis points. So yeah, it's a little bit higher, but it's not extreme at all. So, I would ask trustees, given some of that portfolio construction information in my memo, which are you most comfortable with? Brandis is the fundamental manager here. They're really the different one. They're using value, research. They're doing calculations and trying to figure out intrinsic value, with whatever process they're using, but they're doing things by hand. They're not really doing it by hand, but it's kind of like they're doing it by hand. These other two, AQR and Causeway, they're looking at a lot of different factors. They're using advanced computer models to make their determination. And because they're doing that, they have a stricter set of portfolio construction metrics, constraints that they're using. Neither one is necessarily bad or worse. All three of these managers are quite strong, in my view.
Yeah, maybe I missed it earlier, but can you go back to the slide on 22 or slide 21 where it talks about Brandis and the CEO not having investment background? Is that a true concern? No. Okay.
The slide I keep going back to is 26, and it seems like with Robert's comments, I understand that Brandis is different and is approaching things differently. And in recent history, when it works, it really works. If you look for that period between 2017 and 22, it did not work for a pretty extended period of time. And that's where my concern is it's like, I get that it's oversimplifying the data here, but it's either a home run or a strikeout. And that's...
Well, and I think that relates primarily to whether or not value investing was out of favor, which it was for a period. In this most recent time period, value has really shown. And you see that as a complement to the growth aspect of the T. Rowe Price product. But if you look at page 23, you can see that Brandis is investing in much smaller, well, not much, but closer to micro companies, and on the value end where T. Rowe Price is in the small range and much more tilted to the growth.
I don't want to imply with any of my comments that I'm against interviewing all three. I'm just, as far as complementary to what we have with T. Rowe, I figured AQR was a given that we should interview them, just based on my assessment, and I will rely on all other trustees if they want to interview the other two.
I think in the small cap side, it's not, or sorry, this is the, right?
No, small.
small.
Oh,
Yeah.
small,
Yeah.
we already have, okay. In the small cap side here, it's not as clear as we had in the emerging side that two of them stood out much more than the third. So we don't have any problem with bringing in all three if that's the board's wish.
I would like to see all three.
It sounds like we have a consensus that is formed here. I do appreciate the sports analogy, by the way. We can have more of those. If there is a portion of our portfolio that we're going to swing for the fences and hit home runs, this might be it. So, so I guess the direction to staff here would be to, do we need to go to public comment first? Okay, public comment. Is there any public comment at this time?
There is no public comment.
Okay. The direction of staff would be to interview all three of these managers. And that brings us to, what does that bring us to? F?
So I have one other question in terms of actually bringing the managers back. I wonder about thoughts on interviewing everybody in one meeting versus splitting that up into two meetings. Any two? I see a two. We will have investment, the capital markets update in January. So maybe that would be a good time to bring in the EM managers, since there's only two of them. And then potentially we have the small cap 3 managers in February.
I would prefer to have them broken up. Some of the, it's a lot of information, and I want to make a fully educated decision.
You want to have the 3 managers broken up?
No, the emerging markets.
Oh, yeah,
and
yeah,
then,
yeah. Okay, so like that two meeting January, maybe EM, the 2 EM managers, February, the 3 international small cap managers, separate meetings.
I think it might be good to keep each of the sector manager interviews in the same meeting.
Right.
But yeah, breaking it up in that fashion would be, yeah, preferable.
Yeah.
Or February, March, depending on timing. I mean, it's asking a lot to get it done in January, I think, too, but I don't know.
A lot of times when you want to invest money with them, they're more than happy to make the effort to get here. But we'll put the 2 emerging market managers target hopefully for January. We also have the capital market expectations, as Robert mentioned, in that month. The following month, we'll bring in the 3 small cap managers for interviews.
Okay, I guess we've been at this for a while. Do we want to schedule a break right now? Does anybody, or would you like to power through? Break? Anyone else? Okay, well, let's power through then, and we'll go to 5F.
Trustees, the 5F and 5G are really just informational. You have the memo for the real estate manager activity update. That's just to provide a narrative to help you get a sense of some of the changes that are happening within the strategies. And 5G is actually the same type of thing. Quarterly characteristic update for the infrastructure managers, and a narrative about some of the standouts that the fund has had in terms of the portfolio companies there. So I'd be happy to answer any questions you may have.
Is there any questions, trustees? Is there any public comment? And we'll take both of these items at the same time, if that's okay.
There is no public comment.
And is there any discussion on either of these items? Okay, we will move on to item 6. Audit Committee report and recommendation to adopt the financial statements and independent audit report for the fiscal year ended June 30 of 2024. And I'd like to thank Callan for showing up. And it has me as the Audit Committee Chair, which was a surprise to me. And thank you, Doris, for giving me the verbiage to read now. First of all, do we have any discussions on the Audit Committee findings at this time? No discussions? Okay, and I guess I'll read my statement. The Audit Committee met with the auditors and reviewed the report. The committee recommends the board adopt the report as presented. And
I believe this does require a motion by the board to adopt the reports.
okay, do we have a motion to adopt the report?
I move.
Do we have a second?
I'll second.
And roll call, or do we need public comment at this time? Okay, public comment.
There is no public comment.
All right. And now let's have a vote.
Ms. Cavanis?
Aye.
Mr. Cromer?
Aye.
Ms. Harris? Mr. Swope? Ms. Pierce?
Aye.
Mr. Land?
Aye.
Approved.
Item 7, draft annual comprehensive financial report and the draft popular annual financial report for the fiscal year ended June 30th, 2024. Robert.
Trustees, you have both draft reports for review. We'd be happy to answer any questions, and Doris may want to make a comment.
Well, I would like to thank Robert for all of his efforts with the audit and putting together the financial reports and the PAFR. I would like to point out that once again, due to staff efforts, the reports received the GFOA awards for outstanding achievement in popular annual financial reporting, and the GFOA sorry, I want to get the title correct of the other, Certificate of Achievement for Excellence in Financial Reporting for our AFCR. The PAFR is a brief, short, easy to read summary of much of the information that's presented in the full AFCR. Instead of 104 pages, it's like 9. It just hits some of the highlights, and I really appreciate all the effort from staff on that.
Do we have any board discussion at this time?
Chairland, I don't think we ever do a good enough job of thanking staff for the efforts put together in these reports, and it's almost an expectation since I've been on the board that we will be recognized, but it doesn't go unnoticed, and it is appreciated. And I don't know if it was on other ones, but the hyperlinks from the table of contents that take you right to where you click, if it was, I missed it on previous reports, but it's very easy to navigate and very well done.
Thank you.
Thank you. I would second that as well.
And this does not require any action of the board. It was really just informational. Once again, we'll be submitting these reports to GFOA for consideration for awards for next year, which I obviously believe that they will receive. I appreciate all the work of our external auditors at Brown Armstrong with putting together the financial statements and the information contained in parts of the report. So thanks to everyone.
Thank you. Okay. We will move on to item 8, administrative report. Doris Rentschler, Executive Director.
Thank you, Chair Land. Our office will be closed to the public the entire week of Christmas, consistent with much of the county offices. I did want to point out a couple of reminders that will require action of trustees. The Fiduciary waiver of recourse premium of $9 is due by January 15th. Go ahead and make those checks payable to the County of Mendocino, and you can provide those to Judy. The Form 700 filing deadline is due by April 1st. Just wanted to get that out there so it is on people's radar for your filing for calendar year 2024. And I wanted to acknowledge Judy's and Nora's work on putting together a new web page on planning your future retirement, which pulls together resources and links for people to start obtaining estimates and planning for their retirement from MSERA. And I just wanted to acknowledge their efforts in putting that out there as a consolidated place for our members to go to easily access a variety of information regarding planning for their retirement. If you have any questions, I'd be happy to answer any questions.
Do we have any questions?
There is one other item that I would like to mention, and that is that the Calipers General Assembly is coming up in March. Registration is currently open for that. It starts on, really, it says Sunday, March 2nd, but the first session is on Monday, and it's nearby in Napa, so you probably don't have to go down early to get to it. They do put on a good program. The agenda is available. I would encourage you to look at it. There is also an opportunity for people who need the ethics training for trustees to pick up the ethics requirement at that conference.
Okay, thank you. Are there any comments at this time? Do we have any public comment?
There is no public comment.
All right, that brings us to general board discussion. Is there any general board member discussion items? I would like to just say that I'm going to miss the commute from my office to this board chamber, as the next time we meet, we will be back at King's Court, right?
That's correct. Starting with 2025, January, we'll be returning to have our meetings at the King's Court location.
And I will miss just walking over to my office. So at this point, I believe we are going to move into closed session. And do I need to discuss the items? I believe I do. The board moved to closed session for the following items. Conference with labor negotiator Doris Rentschler regarding negotiations with MSERA staff in the conference unit pursuant to Government Code Section 54957.6. And item B, conference with legal counsel existing litigation pursuant to Government Code 54956.9 D4. Name of case is Los Angeles County Employees Retirement Association versus County of Los Angeles et al. California Supreme Court case S286264. And we will go now.
Have the green light? Okay. The board met in closed session on item 10A, conference with its labor negotiator, and the board gave direction to the labor negotiator. In item 10B, conference with legal counsel on existing litigation in the Lacera versus County of LA matter, the board gave direction to staff and counsel to file an amicus brief, and in that court case, the Court of Appeals several months ago held that 37 Act retirement systems have the authority to create employment classifications and set salaries for their staff. That's it. Thank you.
Okay, that brings us to item 12, and that is the adjournment and notice of the next Board of Retirement meeting. The next Board of Retirement meeting will be held in the Mendocino County Employees Retirement Association Boardroom, 625B Kings Court, Ukiah. And that'll be on Wednesday, January 15th, 2025 at 8:30 a.m. And this meeting is adjourned at 6 minutes to 11. Thank you very much.